Hey, welcome back to my podcast. You've heard me talk about before that I'm an investor in tens and tens and tens of real estate tech companies, prop tech companies, other interesting businesses, a wine and tequila spirits company, all kinds of wild stuff. Today, I'm introducing you to a client and a friend who I'm now doing syndication deals with. I'm telling you this as a public service announcement to let you know straight up front that I'm super enamored by this guy and thrilled to be his business partner. So listen up. You don't have to invest in the deal, but I always got to be transparent with you. So enjoy the show. So Eric, welcome to the show, man.
Thank you. Excited to be here.
Yeah. So you shared the stage a couple times now with us, and I look at the rooms; they're packed. Everybody wants to be a better investor. Everybody wants to understand how to speak the language of investors, so you can add that new channel of business or ultimately be a better investor. Help people understand your backstory, because when they hear that you're 33 years old and you own 700 units, they're like, would he buy his first one at 2? Give us a little context, backstory before we go into we have a lot to cover today. This is going to be one of those ones you're going to listen to twice and you're going to take notes. So
okay.
give him some context.
Backstory. I was in college. I signed up to run a painting business through this company called College Pro Painters. I had no money to my name, and I'm like, you know what? I don't know if I have what it takes, but if there's ever a chance to take a chance on myself, or a time, it's right now when I'm at nothing, because I can't go backwards.
You can't lose, right?
Exactly.
Was it like a franchise?
It was. It was a franchise.
Okay. What did it cost?
So it cost me nothing. They just gave me $10,000 in debt, and they said, if you don't pay this back, we're going to go after you. And
Yes.
I had to sign on the line that and I'm like, good luck. I don't really have any assets, but I'm gonna try. So immediately day one, you're in the hole.
Yeah.
They give you keys for a business. They tell you how to run it, and they say, go out, start knocking on doors, get jobs, hire people, paint houses. Turns out I made like $25,000 as a 19-year-old kid that summer.
Including paying off your debt or total?
Including, at the end of the year, $25,000 in my bank
net.
account.
All right.
So
Congrats.
Yeah, actually, probably profit was a little bit more than that, but, spending it throughout the summer. So, profit to me was cash in my bank at the end of the year.
Exactly.
To a 19-year-old kid.
Before or after taxes? Anybody teach you about that one?
Yeah. I learned a lot. Anyways, I was about to spend that money. I started blowing it on dumb things, and I went and said, hey, I went to my mom. I said, where can I put this money where I'll protect myself from it? And so she's like, I see successful people buying real estate. This was 2009. And so I went out, I bought a house. I looked for something that cash flowed just a little bit more than the mortgage. And that was the formula. It wasn't anything revolutionary at all. It was like wealth preservation was my thought. And so I did that 3 more times. And then, because I thought the idea was cash flow. And so I bought properties I didn't really appreciate. And I just sat on those for a long time. And so it wasn't really till like 5 years ago.
Okay, so hold on though, man. You're 19 years old. You're in college. What were you studying?
I was going to business school.
Okay, so that gives us a little more context. And now you're also I see as a very competitive guy. You run marathons. You're super fit, married, two beautiful kids. Like, you got the whole package today. Were you always this way? Like, buying your first house at 19 I bought my first house at 19, but I was like a high flying crazy sales guy. And my dad's like, you need to buy a house. I was like, are you kicking me out? He's like, yes. Right? Like, that was part of it. So you went from 1 to 2 to then you said 5 years ago you started buying a ton. Yeah. But I want to understand, what was your psychology back then at 19 or 20? You're running a business, you're going to school, and you're buying real estate. That's nuts.
Yeah. I've never been like the most talented or the smartest guy. I've always been like the hardest working though. So I was a guy, I played hockey growing up, and the coaches would put me on the ice, not when we needed to score a goal, but when we needed to prevent the other team from scoring, because I would go out there and work so dang hard, and I'd motivate the team to hey, everyone should skate as fast as Eric. But again, don't pass a puck to me because I'm not going to know what to do with it, kind of thing, right?
He's just going to hit somebody.
Kind of. And so that's been a lot of my life, is just getting out there and just going for it, and learning along the way. And, so I think that leads to also a lot of mistakes, and that's how I've picked up, really where I am is through a lot of those ups and downs. And
sure.
I'm happy to share, and I'm excited to share.
You got pages of notes here. So let's go back. You were saying, but it was really 5 years ago. So take us back to 5 years ago. What did you mean by that?
Yeah, so that's when I sold my first apartment building and really realized
as a broker or one that you owned.
One that I owned. Yep.
Okay.
So I had bought an apartment building with another guy, Conrad. We owned it for a few years, and we sold it and we made $1 million on it. And we really didn't do that much. Yeah, it was crazy.
Well, okay, what was that like?
It just opened my eyes. I started realizing, I'm like, wow, we just kind of fixed it up a little bit over time. We didn't really put any more money into it other than the cash it was generating. And what it did is it turned my mind into realizing that this is more than just a cash flow game. There's an appreciation game, especially if you play it smart and you're buying in areas that are going up and you're doing the right things. And thinking about like who is the next buyer or thinking about like how is a bank going to think about the value of this building and how can you position this building to be valuable a couple of years down the road, pull your money out and then go reinvest. I started thinking about like doubling time of my money rather than just like the % cash on cash return.
Yes. Someone right now is going, slow this guy down, man. He is quick, right? Like you're dropping all these bombs. So
sorry.
No, I love it. So 5 years ago, you and Conrad, who I know, and right, JT wasn't involved then. So right. So you bought a building how many years before?
3 years.
So 3 years later, you sell it, pull $1 million out. Was that including your deposit?
Yeah. No. So that was profit that we.
Okay.
We made.
True $1 million gain, right? And then did you guys 1031 exchange that into something else?
Yes, we did.
Okay.
Yep.
So you're sitting there thinking, wait a minute, this is real. Now this is 5 years ago. At that point, you're 26, 27, 28, right? Like you're young.
Yeah.
And what are you saying to yourself at this point? And then we're going to get into a bunch of the tactics. Like, what are you saying to yourself? Like, how do I go buy 1,000 of these? How do I go buy 500 of these? How do I go do 10 of these deals? What was going on?
That was. We're just like, how can we keep this moving? We realized that there's this space, Class B apartments where super low vacancy, super high demand, very easy to wrap your mind around. A lot of banks love to finance those, so really good lending terms. So we just saw that it's a market that people have been in for a long time, and it's just tried and true, and the formula is just it's out there for everyone to go and to work. And so really nothing revolutionary. And so we're kind of started looking at like, okay, we own a bunch of duplexes, we own a bunch of smaller stuff. How can we start selling some of those and using those as chess pieces, to go after some of these bigger buildings, and I hear that a lot, but it's really, it's the whole scale thing. And what I found out is that, owning bigger buildings, it doesn't necessarily mean you get more cash flow, per door. It's more just like scalability. And, you can only control so many things well. So you might as well control bigger things well rather than a bunch of smaller things well. And so that, and again, it's, when you get into commercial buildings, it's valued based on a formula, not just waiting for the rest of the market to appreciate. So you have more control over some of those levers. And again, realizing how much money can be made through appreciation, how much faster, in the span of a couple of years, you can pull your money back out rather than, just waiting for cash flow over a 10-year time.
Right.
And what I'm saying right now to someone who maybe got burned in the recession sounds very risky. And so what I'm not saying is like avoid cash flow. You still need something to cash flow.
The holy trifecta is cash flow, appreciation, and taxes, and then maybe a trigger, whether you exit or refi. Like that's what you want.
Correct. But what I am saying is that people put too much weight on the cash flow on a deal. They only pay attention to that, and they don't pay attention to some of those other factors as much as they should. Yeah.
I mean, you met my wife. She buys A and B product, duplexes mostly, very expensive ones in my opinion. And her whole thing is like, the only thing I care about is appreciation because I know where I'm buying. And they're going up 30, 40, 50% a year, right? These unbelievable numbers. And she breaks even on it. Right? She breaks even. But the equity that's gained from these things is just monster. So again, let's back up. We want to help people understand how to work with investors. We want to help people become better investors. You have like 5 pages of notes, right? So how do I as an agent start to work with investors?
Yeah. And I think it's important to answer like the why behind that first too.
Yeah.
Just because I look back at my career and, I got my real estate license because I wanted to have like an in on the market. I wanted to see deals before they hit the market. This was like 2012, 2013 when I was getting in. And I had a few friends that saw me, buy a duplex and they're like, Eric, can you help me do that as well? And I'm like, well, I got this real estate license, so why not? And it was what I realized quickly was I learned a lot more about the market by helping others because it wasn't just my neck on the line, it was my friends and, and people who trusted me. And so when you have to teach something, you take it a lot more seriously.
Right.
And so, I think, and I talk about this with my team. So I have this brokerage, Fulton Realty in Minnesota, and all the time I'm talking to my agents about getting into working with investor clients and how to work with those investor clients and what to say and what's important for those clients to hear from you. And so I just think one of the biggest things that you can do to build your success in your own investing career as an agent is one, right? Build the cash through some sales, through investor clients. They're amazing clients because they're repeat. And when they go to maybe buy, that $1 million or $2 million home, they look to you. They're like, you've done a really good job helping us out. Can you help us go buy this other home? Well, absolutely. I specialize, in investments maybe, but no problem. That's an easy one for me.
Was there a course you took or a training you took that gave you like there's different language when you're dealing with investors than there is like helping Tom and Kathy Ferry buy a house?
Sure.
Do you know what I mean? Like, we're talking about cash on cash returns. We're talking about, what cap rate and like, how did you get to understand all of that?
Yeah.
And what advice do you have for the listener?
Yeah. So, back then, like the big thing was Rich Dad, Poor Dad. It's still a very popular book. Still definitely recommended. But Bigger Pockets wasn't around then.
Bingo.
And that's one of the areas that I would go first to find.
So biggerpockets.com, which all they talk about is buying duplexes and fourplexes. And I saw this kid watching some interview. The kid's like 22 years old. He owns like 500 units. I was like, what?
Yeah.
Right? But they unpack how.
Yes. Yeah. So exactly. And I think there's a ton of inspiration and you realize that like, yes, this is possible for kind of anyone to do. Yeah. And they lay out, the strategy to do that. So, back to like in working with investor clients, I think one of the biggest things is like, okay, how do you start working with those clients?
Yeah.
Where do you go to get them? And, just brainstorming some ideas with you, go take a look at, some of the transactions. If you have duplexes in your market, call up the agents that are listed on those transactions and just say, hey, who is the lender? I'm looking for, a good lender that understands this. And then go ahead, make your list of lenders, and then go to those lenders and be like, you know what, this is something that I've been studying. This is something that I'm very helpful in. I can see around the corner. I understand, how to make sure that these deals don't fall apart and coach my clients and build those relationships with those lenders that do those types of deals, right? Most cities have a rental license database where they have all of the owners. It's public information of properties.
Exactly.
Yep. And you can just call the city and say, hey, I'm looking for this database. I know it's public information. They'll send it over to you. Phone numbers, names, emails. Start calling those people.
But you can also get that from Remine. There's a bunch of like data solutions that you can go in and say, show me all the non-owner occupieds. Show me all the duplexes that are owned by an LLC. Like there's all kinds of search queries, but I love the fact of just going right to the public data source and like, just give me everything.
Yeah.
So you get this giant list. There's like 12 million duplexes in the US. Like it's a big number, but they're concentrated right all over the place. But 12 million is a lot of doors.
Yeah.
I guess it's technically 24 million doors. Once you get the list, what do? You say call them, but like, hey, what am I saying to him? What am I asking him? What am I doing with these people?
Yeah. So it's really simple. You're calling on behalf of a buyer. So have someone who's remotely interested in buying, and you're calling, wondering if they're looking to sell sometime in the next few years.
Yeah.
I've gotten really smart with it. When I call those people now, I'll actually call and say, look, I'm a fellow owner in the neighborhood. I'll give them the address of my property.
Yeah.
And I'll just tell them like, hey, I'm going to look to sell my property. Are you potentially looking to add to your portfolio. So then it totally turns off the antennas.
You reverse engineer, like, you want to buy mine?
Yeah,
versus
and,
do you want me? Can I buy yours?
Last week I called a guy, and he was pretty old school mentality, and immediately picked up, and I'm like, oh, this is going to be a fun conversation, and that was, I'm like, hey, I'm a fellow owner of yours. Mm-hmm. I own down the street, and that kind of totally, took the pressure off. Yep. And he was. By the end of the conversation, he's like, I've had people calling me asking to sell my portfolio for years, and I got 25 properties all in this area, and I just hang up the phone. And he's like, I'm getting to that age where I'm actually thinking I probably get better figure out what I want to do, because my family doesn't want to own these things anymore, and I'm past retirement age. And so if you're just a little bit creative with your conversations, you can disarm someone, and you can come in and you can open up those conversations and really build a relationship. And so offering something to them, for sale, potentially, if you have a couple units, can really open the door. And so you might find a potential. And again, if you find someone, they're like, no, I'm not interested in selling. Are you interested in buying? And now you have your buyer list, right? And you start building that buyer list, and you start matching up buyers and sellers. And it's
okay. I want to back up and say, what if they started first by going onto their Facebook or Instagram page or LinkedIn profile and saying, I am studying all of the investment properties in our local area. If you want to know about the deal of the month or the opportunity of the week, send your email here and build up a list. I think most people don't know that they have potential investors that are sitting on the sidelines, like a bunch of your friends that have come to you, right? That all of a sudden they go, yeah, I'm interested. And now all of a sudden you legitimately have 2 investors, 5 investors, 10 investors, 20 investors that you actually know and can say, okay, well, tell me what you're looking for. What's your criteria? Do you want duplexes, multifamily? Are you looking for, whatever it is? And now you're like on the phone with the person, like, I'm representing 20 different investors. 3 want this, 5 want this, 2 want this.
Yeah.
Do you think, am I being crazy with that strategy?
There's an agent in my market, Sam Stedman. He's a Remax guy, younger guy, and he does exactly that all the time, him and his team. Yeah. And it's just like they'll say, hey, here's a great deal. Anyone looking for a deal like this or anything else, shoot us a message. And you just see the messages pile up.
For sure.
Yeah.
For everybody wants access to deals, right? Yeah. And people are busy, like I'm busy, right? Yep. I want to know, but I'm not scanning like the MLS or like LoopNet every day. Like it's just not what I'm doing. I'm waiting for someone to call and say, got a deal.
Yeah.
So one is call the owner because you're an owner.
Yep.
And that's a brilliant strategy, even if it's a single family residence or a duplex or whatever you own. The other one is build your list of potential investors that you already have in your database, because then you can call those owners and say, I'm representing a bunch of people. Are you interested? That's better than just, hey, have you got any thoughts of selling or, yada, yada, yada.
Yeah.
Is there a third strategy when you're breaking into the marketplace to get in with those investors?
Kind of like what I was saying, just with the lenders. I think there's a lot of angles. Figure out like who are the guys that are consistently in those deals. But like in Minneapolis, and I don't know, in whoever you are, wherever you're listening, if you have some networking groups, we host events, and there's a lot of events. And so I think just,
what kind of events, so we're clear on what you're talking about?
So just real estate investing events, so, look for one with a good speaker, with someone who knows what they're doing. And I think just going to those and networking with buyers is a great way to start meeting people. And again, if you have a couple properties and you can go into one of those events and you can share, you have something to offer. That's very powerful, and I think you'll do very, very well.
So I was with Andy Dane Carter a couple of days ago on a podcast, and he talked about kind of a similar strategy. He said, I know the 12,000 investors in my marketplace.
Yeah.
12,000. That's a big number. And he's like, and I'm marketing to them every month, meaning like they own a duplex, a triplex, maybe an old SFR that he thinks he can like create greater yield from if he bought it and fixed and flipped or whatever, tore it down. And he's like, I'm marketing them every single month. Do you think for the person listening right now that once I've talked to a couple lenders and I got a context for like how the bank views an investment deal versus just buying a house, right? And I've maybe identified a couple of people that are my own investors potentially, right, in my own database, and I'm making some phone calls to some other owners. Do you think they go that extra step? Have you done something like that where you're like, I know who owns all the investment properties in Minnesota. I'm going to market to them.
Yeah. No,
and if so what do you market?
Yeah, so we've done exactly that. We've what we did for quite a while is we would write letters to the sellers, and we'd have someone hand address all of the letters, so they'd be opened up, and it's the whole "I have a buyer" campaign, for your duplex. We would send them to multifamily owners. We'd segment the list, people that own at least 2 or more. So to try to segment out some of the owner occupied ones, because maybe they're a little less motivated if they live there. And we had a ton of success with that, and that would, we would say they're looking for a property in your specific neighborhood, and there's a lot of templates out there for that. So, so I think that's well. And then, we would also invite these people to our events. So we would have
talk about the events.
So, one of our first events, we had this guy come in, and he had figured out how to get to 400 units by 40. And so we just said, learn how to get to 400 units by 40. We put it out there on Facebook. We advertised it. I think we put $100 behind the advertising.
Right.
We sold tickets through Eventbrite.
Really?
Yeah.
Okay. And, why did you make them pay versus just show up?
So very, very cheap.
I imagine $5, $10, whatever it is.
Just commitment.
Okay.
Yep. And we had like 200 people show up. It was incredible.
Okay. When you were doing that, like every time I've said to people, hey, you should throw a client appreciation party, they all say the same thing. Oh man, no one's going to show up. Or I'm going to tell them I'm going to do this mega open house. You taught me I'm going to have sushi and all this stuff, and no one's going to show up.
Yeah.
They always show up.
Yeah.
Were you a little nervous with 400 people showing up or 200 people showing up? Walk us through that.
I was very nervous. I was like, holy cow, this is very real. So it was like all hands on deck. But what we did is I think we opened it up to 50 people at first, and then we sold out that, and then we opened it up to 100. And so that was kind of the strategy. So we'd keep like selling out and then opening up more tickets. And so it would look like the event was sold out, and people would send us messages like, hey, can we, and so we'd advertise it like 3 weeks before. And so, you would see how many people had RSVP'd already. And so it was kind of one of those things where, once we got rolling with it, the momentum just kind of kept carrying it. And
so walk us through if there was 4 or 3 phases of the event. Like there's the meet and greet registration process. There's the opening of the event. There's the middle of the event. There's the close of the event. And then there's the after event follow up. If I were to kind of look at even if it was a 1 hour deal, walk us through each part of that.
So we would have a couple people like checking everyone in, and then we'd give them like a Fulton pen and a notepad to take notes or something fun. We would hire a bartender to come in and serve some drinks, so we'd have an intentional.
So it was a morning function.
Exactly. Yes. And what we would do is, we'd have some good food, we'd have some good drinks, we'd have like a half hour of networking, we'd have people put a name tag on and like what part of the city that they lived in. So there's like an instant kind of icebreaker type of thing. So people could go around and meet each other. And then, we'd bring in a speaker. So that way, we could draw people in rather than just like some like salesy topic, like learn how to do this. No, like learn the story of this person, and something kind of catchy. And then at the end, we'd have Q&A. And what we would do is we'd bring in like 3 speakers, so once a month. And then on the 4th month, I would be the speaker. And so what ended up happening is we'd build all this like loyalty, trust. It was like give. And then when I was the speaker, it was more like, hey, this is what we're doing.
Time for the ask.
That was the ask. Yeah. If you want to, learn more about getting into investing, like my team is here. Everyone raise your hand, like come talk to us, come find us, and like we'll help you get started. And we got a ton of clients.
Oh my God, yeah. Okay, so I it's interesting because when you said, alcohol and food, I thought that would be at the end. You're like, no, I'm going to liquor them up, give them some food, then I'm going to educate them.
Yeah.
And I love the fact that you played the long game, that it was just give.
Yeah.
Hear all these other people's stories. And then we listen to the story and we're like, oh, I can see myself in Eric. I can see myself in Katie. Like if she can do it, I can do it. Yeah. And then, so you would do 3 of those in a month, or you do like one a month?
Yeah, like one a month. Yeah.
So you go 3 months. Were the rooms getting bigger? Were they getting smaller? Were they getting more refined? So when you finally did the ask, Like, how did that work out?
Yeah. No, they were just getting bigger, and every event was kind of building. We were, at the time, we were renting space in WeWork, so we were capped, like a couple hundred people. So we actually did eventually have to cap the events.
Yep.
But yeah, it was fantastic. And again, it was one of those like culture building things, like for my team. It was a way for us to get out there, everyone on my team, and start talking about investment properties.
Yep.
And it was a way for us to align ourselves with some people that are doing some pretty cool things in our marketplace too. It was just giving back. And there was a lot of other agents that came to our events. And actually some of like the best agents on my team now, I actually met that from our events that came.
Really? They were just events. More investor minded.
Yeah, exactly. Yeah. And they saw like, look, they didn't have to do anything to come to the events. Like it was all give. And everyone that came, they would register on Eventbrite. So we had their emails, we had their contact info. So we weren't like trying to get contact info as they're walking in or anything. And if they weren't registered, we'd make them register on an iPad. So we knew everyone that was there too.
So when you did the final, not the final because you obviously continue to do these, but when you did the ask, did you also tell your story and then do the ask?
Correct.
Or, okay.
Yep.
Yeah.
And really, I've added a ton of properties in the last couple of years. So I'm thinking like this is all pre-COVID when we did all of this. And, I was building and I had a pretty interesting story of how I was building. But it wasn't the coolest story out there. At least to me, it wasn't.
Yeah.
But
you lived it.
Closer.
Yeah. The rest of us are like, how'd you get to 700 units? You're 33 years old. Like, how'd you do that? So you tell some stories, kind of case study, before and after. This is what I look for. This is how we look. You're probably doing some educational work like that.
Yeah, and then I would actually like take people through like, hey, this is my next move. This is what I'm thinking about. Like I'm looking at like these two commercial buildings. These are my options. Like, hey, room. Like, what do you think I should do?
Right.
These are the pros and cons. And then I would have people. It'd be kind of interactive a little bit, and then I would walk them through like my logic. Like this is why I'm actually going after this deal. And so like case studies and that worked super well. And we'd have people that stick around, would wrap up our events and people would just stick around and hang out and network and people just kept coming back and they would bring friends and I it was because like they kept coming back that I thought we were probably doing something right.
Yeah. I think of Lauren McGuire, who might be listening to this from Southern California, who's one of our team clients. And she actually took a bunch of team leaders through this where she's like, okay, this is the first one I bought, and here's why I bought it. It was a C- set of units, and da-da-da-da-da. She goes, this is my first baby. And she literally had a map, not a map, but like a big visual of like, here's the first one, here's the second one. And she got to like the 16th building that she had acquired.
Yeah.
And she's like, do you remember that? I'm looking at Brian, who's off camera here. Like she literally walked through case study examples of this one was this part of town. I was a little bit nervous about this, but like the people were wonderful and I fixed it up and here's how I did it. Everyone sat there in the room just going, shit, okay, this is not that complicated.
Yeah.
It's set an intention, know why you want to do it, learn some of the language, and then go roll up your sleeves and go look at deals.
Yes.
Right? Like she was going from, Southern California to Tennessee to buy all these deals, and she's bought a ton, like I want to say it's like 16 or 17 buildings. Remember that presentation? Like it was over the top. Okay, we've given them a ton of value for the listener of things that they can do, right?
Sure.
To become better.
Yeah.
Let's talk about actually being an investor.
Sure.
Right. Let's get into your mind. Like, tell them about the Houston property or the deal you're just down in Austin looking at, or the last deal that you did that maybe had some hair on it. Like, educate me as an investor.
Yeah. So, one of the important points I wanted to make was like how I learned that I'm not just a cash flow investor. And so I think I want to talk about like one of the mistakes that I made.
Yeah, please.
And that was buying a portfolio of 16 properties in Cleveland. And nothing.
Sorry, Cleveland.
Nothing wrong with Cleveland.
Yes.
But my motivation was it had like the best price to rent ratio in the country, meaning you could buy them for cheap. We'd buy these properties for like $30,000 a piece, and you'd rent them out for like $700-800, which is incredible math.
Yep.
And it's like you can't lose. You own this for a couple of years and you'll be able to buy another one. But the problem is, in the submarket of Cleveland, declining population. So people were moving out, and that is a problem because that really hits your vacancy. And vacancy is the most expensive thing in real estate. And even, we own these properties free and clear. So myself and another guy. But we couldn't make money, even not having a mortgage. Because, we'd have vacancies or people weren't paying rent, and you'd have eviction costs, and then you'd have turn costs, and then you'd have release costs, and then higher insurance, and all of those things. And so, I was going after them purely because of cash flow, and the cash flow looked incredible, without considering at all what the appreciation might be. And so owning them for 3 years, not really making money, and really, we could have been successful, but it would have taken a lot of time and effort that I just wasn't willing to put in. And so realizing that you can really, and again, after flipping some apartment buildings, realizing the potential of appreciation and some of those levers, those forced appreciation, I realized that there's a lot more money on the table there. We got out of that portfolio, pretty much sold it for what we bought it for. But one of the most important lessons.
Net probably lost because of the, lack of rents, right? But in and out.
Yeah. Correct. But again, I'm very thankful for that because there's so many things that it taught me. And so, that's where I've come to the realization that, really pay attention to the trends, pay attention to where people are moving. Because where people are moving, housing is scarce. When housing is scarce, this is more basic supply and demand. People like to throw in all these extra, factors. But, at the end of the day, it's more supply and demand. There's not enough housing. Rent is going to go up. When rent goes up, your value goes up. When rent goes up, your cash flow goes up. Even if you're buying in an area that is very hot, the logic of I can't buy there because it's hot right now and everyone thinks about it, it is just a way to sit on the sidelines forever. And so for me, I think one of the most important things, Conrad, my business partner, kind of my main guy that I've been investing with for years, we talk about is if the deal makes sense, if it cash flows and it hits the numbers that we need to, and it's in an area that we think is appreciating, we buy it. And we don't get too concerned about what the previous owner bought it for 3 years ago and how much money that they're making on it. We don't get too concerned about, the guy that bought a deal, on the other side of the street for maybe $10,000 less per door. Good for him. He got a great deal. We're getting a good deal too, especially if you look 2-3 years from now of where things are heading in this market.
That's the thing. Talking with Andy yesterday, I said, my mentor, his boss, bought a building in Los Angeles called One Santa Monica Place, and it was like a $350 million deal. The guy was 70 when he bought it. Right. And my mentor is like, you're out of your mind. This is crazy. Why are you doing this? And he said, hey, in 20 years, this is going to be a deal. Now, 5 years later, it was worth more than what he paid for it. Right. 20 years later, and we're not even at the 20-year mark yet, it's probably gone up twice in terms of value, just because it's in the heart of Los Angeles, right off the 405 freeway as you enter Beverly Hills. Right. Location.
Yes.
So you say if the math is right and we think it's in the path of progress, or we think we're going to get appreciation, then we buy it because we're going to make money, whether it's right now or in the next 3 years. Tell us the mistakes to avoid, right? You started going there with avoid the, hey, if the market's going the wrong direction. But what other mistakes have you found that people make when they're buying their first duplex, fourplex, eightplex, 20plex, 100plex? Give us rattle off a bunch of them. What are all the things that they need to be paying attention to?
So, we bought a building in Dallas and we told the owner that, hey, we need the occupancy to be at 94% for us to close on the loan that we're getting. And it was at 80 something. And so he just filled it up, took no security deposits. Whoever came in first.
Threw in bodies.
We inherited some really tough people. And again, that is very expensive. So understanding the quality of the tenants that you're buying right off the bat, is important. And, do they have security deposits, right? And, had they been screened, so what are you actually inheriting is one of those things that I think not a lot of people look into.
How do you do that? How do you do that?
Well, just kind of like I said, look at, pay close attention if they're a new tenant, pay close attention, did they pay the first month rent and when did they pay the first month rent? And what is their security deposit and how does that compare to the rest of them?
What about credit checks and all that kind of stuff?
So making sure that they went through the proper checks, and did they hold the same standards, for the people that they filled it for, especially if, you're in a situation like that. I think another thing that like we've avoided is, so we're investing in the Houston market. We bought 2 buildings in Conroe, Texas, and we were looking at 2 other deals there. But, one of them was right on this railroad and barbed wire right alongside the building, and just a really kind of industrial, not so nice area. So just because an area is growing really fast, like the Houston market, and especially a submarket like Conroe, doesn't mean that you're buying a building in a desirable area in that location, and tenants may not want to necessarily rent there. So really focusing in on that hyper local, just like you were talking about with that Santa Monica deal, because of its location, specifically where it is, there's a lot of value, so don't just take that broad brush approach. And then, I made the mistake. I invested in a syndication probably like 6 years ago. There was a guy, it was his first deal. He had never really done real estate, but he came from this real estate family, and his dad had a big name in real estate property management.
Like the pedigree, but he didn't have the personal experience.
He was kind of a goofball, and when he walked in the room and I could tell he hadn't showered in 2 weeks, that should have been the first trigger, but I'm like, this is really
maybe
weird.
He's a savant.
Yeah, exactly. But and so I even think about like how, because I'm invested in that and only, $30,000. So not losing my retirement. And I have a few other friends that had invested in that and told me about it. And so I got into it as this new development and in a good area. But it just hasn't really turned out. Good area, good building, but the wrong operator.
Right.
And, how could we have known, what the right operator is? And so we've had a lot of those discussions. It's like, how do you vet it out? Well, first of all, like him running it without having the experience, just trusting the family name, was not the right approach. And then, really, I think about it, like if I'm going to invest in someone's syndication, I want to know like how much of your own money are you putting into it?
Right.
And then who are the other investors you're bringing along? Are they family, their friends, like, and calling some of those people and understanding like, okay, like who are you? How much are you putting into this? What's your connection? So kind of vetting out some of that. And we got brought into the deal late in the game. So they had fundraised money, they had built it, but they were, they needed to fundraise more. That should have been a red flag of like, why do you need to raise more money when it's already built? Like what is going on here?
Yeah. What's the problem?
Again, you look back, 2020 vision, but, so I don't know, hopping around to a couple different things, but
what about, like tell us about a building that you bought that afterwards you're like, whoops.
Okay.
Maybe you didn't do enough due diligence. Maybe you didn't, walk the property enough. Maybe it was just too, like looked too good to be true, and then you found out that it wasn't. Have you had one of those yet?
Yeah. There was definitely there was one building where we bought it and there were no it was 24 units and there's no water shutoffs to any of the units. So you had to turn off the entire building if you wanted to change out one sink. Or so it just like
slightly inconvenient.
Yeah. So that's like one of the simple things. It's like we're buying something now. Like, does it have water shutoffs to each of the units? Right.
Right.
So just maybe some things like that. Or there was a time where we had this is kind of a funny story now. It wasn't so funny at the time. We had inherited this property manager. Or really, it was a caretaker, and there was this complaint of someone was smelling weed down the hallway, and it stunk really, really bad. And they're like, it's coming from this unit. And we send someone over there, the caretaker, to check it out. And she's like, no, it's not coming from that unit. It's definitely not. And we're like, we're pretty sure. We get like 5 complaints that it's that door. And after like 3 times, we sent someone else, and they're like, yeah, it's definitely that unit, but that's the caretaker's dealer. So, so
we give him a pass.
Yeah. And so it's just like, reading between the lines a little bit, and it's just like, okay, well, we like that caretaker, but now you got to go, and now that person has to go. And, so it's just some of those like funny things that are, really not so funny, but, you just got to kind of use some common sense and read between the lines a little bit. Yeah.
But you only get common sense after you've made the wrong, like I think about the second investment property my wife and I bought together. We bought it in 2008 in an area that had expanded dramatically, like in a condo conversion. Yeah. And we're like, okay, we're getting it for a really good deal, we thought. Yeah. By the time we closed, it was worth less. a year later, it was worth dramatically less. And then the tenant left, and we just were like, oh man, like that was just such a mistake. Sometimes we think price is the only determining factor of a good deal. And we missed all the things like where it was located. It was a condo conversion. Not saying all condo conversions are bad, but like in that area, they did so many of them. It was just a mistake.
Yeah.
We lost everything on it. Not our entire net worth, just we lost everything on the deal, right?
Yeah.
So like, I think you sometimes have to make those mistakes. Like you mentioned earlier, like starting your first business in college.
Yeah.
Like, well, I have nothing. So, if I lose a little, like who cares? Because I don't have anything.
Yes.
A lot of the people listening have more.
Yes.
Right? They've been making a ton of money. They've been, a great client of ours, or maybe just someone that's just listening to this, and maybe they're 25 and they've made a fortune in crypto, and they're like, yeah, I probably need to like diversify a little bit and get into some real estate. So they don't want to make those mistakes.
Yeah.
So you've given them a bunch of the mistakes. Talk about how to do it right. Flip it.
Yeah. Yeah. So, and that is like why I love real estate. When I was talking about like losing and going nowhere, like that's starting a painting business, starting in debt, like very risky thing. And even like my worst real estate deal, what I was talking about with Cleveland, I pretty much just stayed neutral. And to me, like that was a loss, but that's also kind of
it's time and money.
Yeah.
Right? So
the beauty of real estate, I think about it, I've read some books on like old money, like how does like money last for hundreds of years, what is the investing philosophy that someone that needs to keep their money for 200 years, how is that different from someone who's just planning for their own retirement?
Yeah.
And how does that look? And it usually looks like a lot of real estate.
I was just thinking all of Europe.
Yeah.
Like if you go to Europe, like a buddy of mine rented a chateau in Lake Lugano, and the family owns like 3 houses on this street, these giant, like 10,000 square foot, magnificent old, grand properties looking down at the lake. And they're like, well, you can lease the property, but the minimum lease they would do is 10 years.
Yeah.
Think about that. You're leasing a house and the minimum we do is 10 years. And the 3 or 4 houses that they owned had been in the family for like 125 years.
Yeah.
Like it's like the 3rd generation now is taking the lease on these deals, and they own nothing on them.
Yeah.
Like, so I hear that, I think, but how does that translate to the person listening right now that maybe is thinking about a 3 to 5 year deal?
Yeah.
Or their own personal finances.
Yeah. So, I think the important thing is, you start small. I've met so many people that are like, you know what, I want to get into this and I just want to go big right away. I just want to save up. I want to buy an apartment building. And I think going after that yourself is kind of a mistake because the people that buy apartment buildings, it's because they started with duplexes and they've 1031'd into those. They don't save up the money. Yeah. It kind of like I said, nobody saves up the money to buy an apartment building. They trade up to do that.
Say that again. Say that's a very important distinction.
Yeah, nobody saves the down payment to buy an apartment building. It just doesn't happen. They trade up, or they pool together with investors.
A syndication,
something like that. So yeah, I think.
Did you guys hear that? I'm looking at like, a couple of my teammates over here, like, hello, right? Yeah.
Yeah. So a couple ways to start. There, you could also invest in a syndication, but one of the problems, and I've invested in a lot. There's a lot where it's like, give us your money, we'll give you a return, and it's kind of like put your money into this black box and it spits out. And that I think could be a big
spits out cash.
It spits out cash.
Yeah, and you get a tax deduction, and hopefully if they refi, you get a trigger and you get appreciation. So
yes, it is good, but like we're talking about learning. Right. And we're talking about like getting that experience.
Yeah.
And
you don't get to get into the weeds and get educated from that person. They're just like, here's your money, here's your return.
Yeah, and that's great. And for a lot of people, that's exactly what they need. Mm-hmm. They need a good tax benefit, and that's what they should do.
Right.
But if we're talking to people that, again, they built some money, they can't lose, but they, I think people need some experience, they need some confidence. Right. So if you're going to do that route, make sure you're working with a syndicator or someone that has an experience of being able to teach you, has the time, the capacity, and a way to bring you along the journey a little bit, because there are definitely people that have that heart and can do that. But again, I think it's start small, buy a duplex, buy a fourplex, and then think about your doubling time. Think about like,
what do you mean doubling time?
Doubling time is when can you take that property and double it, make it turn it into 2. So essentially pull your down payment out of it and buy another one.
Yeah.
Right. And a lot of times that happens much, much faster through appreciation, through doing a couple little upgrades to a property in a hot area than it does through saving the cash flow of that property. So if you turn your mindset to that, then you start looking at the landscape as like a land grab. And, right now, I think people, especially, we talk about it. You and me are young. You say I'm really young. You say you're young. I agree with both of those statements. Right now is like a land grab. It's go out there, acquire, and later in life you can switch to more of a cash flow play. Where you do things where maybe you have a little bit lesser of mortgage. You're just paying down properties and you're focused more on cash flow. But there's so much wealth I think going to be created. Over the next decade.
I interviewed Ivy Zellman a couple days ago, and we're talking about Ivy's like the oracle of housing, right? She's talking about the 9% additional transactions that were done in the U.S. above and beyond what happened in 2020, which was a record year. She said, but the 9% difference was almost all investors. And we were referring just to SFRs, right? Single family, right? And she said the vast majority of them are all these giant hedge funds that are saying blue collar workforce housing, $250 to $450, rents at X amount of dollars, and they're just buying $75 a month from one broker in one city, $75 a month from another broker, and $75 a month in all across the U.S., mostly in sand states, right? Yeah. Mostly in sand states, and their mindset's the same. I said to her, "Do you think any of these investors are nervous about what's to come?" And she's like, "If you buy right and you hold forever and you get rent, who cares?" That was basically her response. She's like, they're not buying all these properties today thinking it's going to go down in value.
No.
They're thinking the migration pattern just of the last 20 years from, call it the north to the south, right? Colder to sand states. Yep. She goes, that's going to continue. It's going to continue to drive all the things that we're discussing in terms of appreciation, less housing. She's like, it's a no-brainer. So we're seeing it on this scale that's actually, and I say this with a lot of respect, it's hurting a lot of residential agents that are doing this. We're talking about a different land grab, which is the land grab of multifamily.
Yeah.
How much of multifamily today is owned by or being you're up against hedge funds versus other syndicators versus mom and pops?
Yeah. So right now, a lot of the stuff I'm buying is, sub 200 units. So a little bit too small for some of those big hedge funds.
Isn't that amazing to think less than 200 units is just a little too small for those guys?
Yeah. So
perspective.
Yeah. So it's mostly just individual investors and small groups of buyers.
Yep.
And that's been really fun to play in that space, and especially because we're bringing some things to our deals that are a little bit different than how people are normally thinking about it, such as solar. And being able to take a deal that is pretty good and make it very good. Through some tax.
I wasn't sure if you were going to bring this up because I wanted to talk about the model, right? Because everyone knows I'm an investor with you in these things. We're talking buying C property, right? Which is A, B, and C property, and I love the from C to clean.
Yeah.
Right. We're taking the C and making them clean.
Yeah.
So give us an example. Talk about the Houston deal or another deal that you're doing that where you've had that experience, and then what are all the tax savings and ways that you make that property more valuable?
Yeah. So I think I'm going to talk about it on a little bit smaller scale. So a 10 unit, because I want people not to miss this because it works on smaller deals.
Yeah. Could work on a duplex, a fourplex, but
we're doing this on a 90 unit deal, but on a 10 unit deal in St. Paul, Minnesota, we added solar. So we spent about $87,000 adding solar and a lot of the upgrades, the panels. Part of that upgrade was also we gave every single unit air conditioning. They used to have little window AC. And I know that's maybe a little foreign in Texas, you don't have your own dedicated thing. Well, in Minnesota, you don't necessarily need that. But is more valuable. So with an $87,000 investment into solar and electrical and AC upgrades, we were able to take a 26% tax credit on all of that. So a tax credit at the end of the year. So let's just think about it we spend $100, the government sends us 26 $6, and a tax credit back. To finance that, we we put 20% of the cost of that in. So we get a 6% delta back. So it's like infinite returns, kind of right off the bat. We're able to cut our electricity expense about 15%. So that hits
big
our
savings.
P&L. And then we're able to increase the rent of these units because they now have AC. So we were able to bring in about 17 grand extra per year on our P&L.
Per door?
For the whole building, for this 10
whole
unit.
building.
Yep. For this. So not crazy number. So $87,000 brings in an extra 17. You're like, okay, big whoop. But when you consider the value of the building, based on the 5 cap rate that we bought that, it's actually like 5.5 cap. That added about $320,000 of value to the building. And on a $1.2 million building, that's like our down payment. So now, we spend this money. We're able to finance it and get a tax credit back and get paid to do this. And now we're able to go cash out, get our full down payment back, pay our investors back, and go buy another building. And now we own this thing. We're not into it for anything. And we're making more money on the building, and it's just through using.
You say that so fast, like it's so easy, but I know because you've done it so many times.
But here's the thing: it really is not like it. It's a process, and you got to understand the process, and you got to go through the work. And it's just like as an agent, if I were to go out to one of my clients and be like, "Oh, selling a house is easy. You just do this, and this," and like to us, it's like
it is easy.
It is easy
because you've done it.
But to a client, you're like, "Holy cow! I'm definitely hiring you because everything you said is way over my head." But you and I both know, you just need to do it a couple times, and pretty soon, with the right coach and mentor, it actually is easy. It's just a process, and a lot of this too. And the thing is, the playbooks are all out there.
I know. I know. That's the thing. Like the information's everywhere. Okay. 4 years ago, we're at a team retreat in Huntington Beach, California, and for fun, I brought my tax guy there. Now, my tax guy is very unique in that he has a personality. He is a great communicator, but he's wicked smart when it comes to the tax worlds. Right. So he's asking everybody in the room, how many of you own a building? Right. And one of them, Doug, had just, Doug Edrington raised his hand. He goes, well, I just bought a building. He goes, like, you should do a cost segregation study. And I watched everybody in the room go, cost segregation study. And then he says, let me explain. So would you explain to the person, what is a cost segregation study? Approximately how much does it cost, and what happens when you do that on a building?
So I just think there's like a 50 unit building in Waco, Texas. We're paying somewhere around like 10 grand for this cost segregation study. It's going to save us probably, I don't know, like 60, 70 grand in taxes, right off the bat, year one. All it's doing is, you depreciate an asset over a certain amount of time. Cost segregation just allows you to shorten that window and do most of your depreciation right up front. And by the way, especially if you're in like an opportunity zone, there's some insane benefits here. But what's the benefit of that? Well, you pay way less taxes today. So you're able to invest that money and buy another building, today, and start getting in on another building on today's prices instead of 2 years from now prices. Start making money on that. And so it's just a way to grow exponentially, and especially with being an agent and your income, coming from real estate. Now, let's say you actually make money on a building, but you show a loss. That building in St. Paul, I'm showing a loss. We're cash flowing very well, but I'm showing a loss. And so now I take this loss on that building and I apply it towards my other income, my income, as a real estate agent. And so I can offset a lot of my other income.
All legit, all typical, very normal in the tax code.
I'm just playing by the rules that are written. So now I'm able to just keep more of my money in investing. And now, of course, you're not avoiding taxes. You're just deferring them. But again, it's the power of having your cash and being able to invest that now rather than later. And it's like anyone who is well into this business and making some decent money, if you're not investing in real estate and taking advantage of things like cost segregation studies, you are leaving so much on the table.
Okay, so you and I could sit here for like 7 more hours. You know what I mean? Just what about this and what about that? What about this? And one of the commitments that we've made in this partnership is that we're going to do more education work. We're going to do more training. We're going to give people more exposure. So how should somebody, if they wanted to connect with you, they wanted to hear more about you and what you're doing and what we're doing together, how do they reach you?
Yeah, I think Instagram is one of the first places. Like that's where I'm putting a lot of content, and so if you like,
you are doing a ton of just like, let me explain how to do this deal. Let me tell you about the. I mean, like I love it.
Yeah. Thank you. I've taken the models that you put out there, Tom.
Educational marketing, brother. Like that's what it's about. Yeah. Okay. So what's your Insta handle?
So it's just my first and last name. So Eric_Eickhof.
Okay. Yeah. All right. You might want to spell that one.
Yeah. Eickhof.
Yes. You're Italian, right?
German.
Yeah.
Come on. Okay. All right.
I'm busting your chops. Eickhof. It just sounds so Italian. German, the language of love, right? That was my buddy who's German once said that. He said, German, the language of love. Okay. So they should reach you there. 2 or 3 books that they should read. And besides Bigger Pockets, where else should they go if they want to go deeper on content?
Yeah. So there's a book called Family Fortunes that I think is fascinating. Yeah. And, it was written in 2012. And so they're kind of predicting a little bit more of, is after the downturn and they think things are going to keep heading south. So there's some stuff that turned out not to be so true in there.
Sure.
But there's a lot of like really interesting content just to think about like how does true old money think and how do they invest? And it's not a real estate investing book.
Yeah.
But it's just a mindset. It's kind of like, kind of like the Rich Dad, Poor Dad.
Yeah.
Bigger Pockets stuff. And then, for me, I'm just, I don't think you're going to really like this, Tom, but like, I'm not necessarily like a big goals person. I don't like wake up and think of my goals. I think more about like my habits. Like what are the things that like, if I just fall back on, like I will guarantee like, hit a path that I want to hit. And so, you think of like Atomic Habits, you think of like the Power of Habit by Charles Duhigg. I think those are huge. And then, really like Donald Miller, Building a Story Brand is
spot on.
Best marketing book. And then, I think, my favorite like inspirational book is probably Shoe Dog.
Phil, the Nike, right?
It just brings in like
I was just such a different, you're like, Bigger Pockets and then Atomic Habits and then, Shoe Dog, right?
It's important to have fun, when you're listening, not just like inspirational stuff.
I agree.
And it's everything until he went public, and it's all like the, the behind the scenes and like what it's
like the really grind, right? It's the story, right?
And the he was a runner and he was a competitive, athlete. And so there's just, to me, like a lot I could resonate with, and he ties that into business and it's just, it's fun and inspirational. So
I interviewed Tim Grover on my podcast, and Tim is just who's Michael Jordan's trainer, Kobe Bryant's trainer, and he tells the story of like walking into Michael Jordan's house, and the first thing Jordan did was look down and see that he was wearing Converse, and he's like, take those off. Right. Phil and I would love that story. Yeah. Okay, so as we wrap up, they should follow you on Instagram. They absolutely. I'm gonna immediately get today Family Fortunes. That's a killer one. All the other books I have the Shoe Dogs book. I actually flew on Phil Knight's plane once, which was super interesting. I'll tell you that story later.
Yeah.
But here's the thing. People want to get better. There was a lot covered on this. What I would tell people is you probably need to listen to this 2 or 3 times. You definitely need to follow him on Instagram. You need to start looking at what are successful people doing. He is an excellent role model. Maybe it's not you. Maybe it's like have your 20-year-old, right, listen to it. Have your 25-year-old listen to it. I'm looking at these two over here. Like, are your brains popping just a little bit over there? Right? At 23 and 25, like Mr. House Hacker getting ready to buy her first house. Like you can do it. I guess that's the message I want to say to people. You can do it. Just like you learned how to listen and sell real estate, this is the same. It's a little bit different language. It's maybe some different contracts, some different legalese, but you can do it. And I just encourage you to start. Make sense?
Yes.
Closing thoughts?
Gosh, I mean, so much of what you just said, Tom, it's like, don't worry about like hitting a home run on your first deal.
No.
The people that have made the most money, just focus on base hits.
Bingo.
And that's really all I focus on still.
Yep. Singles and doubles, brother. Singles and I'm a big fan. Singles and doubles.
Yep.
Eric, thank you so much for being on the show, man. Make sure you follow him on Instagram, like, subscribe, ring the notification button, or however you're listening to this or consuming this content. And please continue to give us more feedback, more comments. Let us know what else you want, and we'll promise to deliver. All right, we're out.